Kayer, it's a green-looking Indian screen, something that we saw in the global markets as well, and that continues. A lot of earnings which are coming in. We'll discuss that and a lot more. So we do have all the stocks on your radar on the show today.
Quite a lot lined up on the show. It's a green screen, mid-cap and small-cap end of the market is doing especially well. The top headlines for the day, stocks see broad-based gains with advances far outnumbering the declines. Mid-caps rally with the index surging over 2%. Pharma and letters lead the surge while private banks remain the big laggard.
Gulf oil surges on good Q1 earnings. Profit rises 29%. Management tells CNBC-TV18 they will grow 2 to 3 times the industry growth in FY25 in terms of volumes. They also guide for double-digit revenue growth in FY25.
PI Industries climbs more than 3.5% after delivering a strong set of numbers for the first quarter. The performance was led by improved margins. The company maintains a guidance of 15% revenue growth with sustained improvement in profits as well.
Cummins India surges despite a mixed Q1 performance. Management in the earnings conference call clarifies that global parent commentary does not apply to Cummins India. Say exports have bottomed out and record high margins are not sustainable. Okay, for the markets, it's a 213-point uptick on the Nifty right now, and this comes in after that last-minute fall that we saw. So we'll have to see whether we maintain these levels or not. The last 1 hour will be very crucial. The mid-cap is doing well, outperforming the benchmarks. That index is up 1.7%. Nifty CPS index, that's the top gainer. The likes of ONGC contributing there. Nifty Metals index is the other one. So largely, most of the sectoral indices, they are in the green. Actually, all of them are in the green right now. We keep getting in earnings. BASF, for instance, is up 10% on the back of strong set of earnings. And we'll discuss a lot more on the show as well. But so far, looking good for the broader markets.
Absolutely right. So earnings coming in thick and fast, like you mentioned, BASF up almost 10%. Minda quite flat at this point of time, just declared its results around 15 minutes back. But the one stock to keep on the radar is Venky's. The company declared a strong set of numbers and the stock is currently perched at the upper circuit as we speak. The results just came around 10-15 minutes back, up 20% at the upper circuit. But this is our special segment, Mid-Cap Movers. Hormaz is at the wall to take us to the mid-caps that are moving around in the session.
Very crucial final 120 minutes for the trading session just to see whether the gap up that we have had through the day sustains or not. And start off with some of the movers in the broader markets. They continue to do well for themselves. All India ahead of its results, up 8% now. At one point was up almost 9.5%. Supreme Industries is having a good day, as is Zomato. 265 now on the stock, 6% higher. And Castrol, after a bit of a dip, is seeing some buying at lower levels, 5.5% higher today as well. As you mentioned, earnings continue to come in thick and fast. Cummins, after a positive management commentary, 7.5% higher today. Lupin's numbers had a good number there, so Street is rewarding it, 4.5% higher. PB Fintech as well, 5.5% higher. And Gland Pharma on the downside after the earnings miss is trading lower by 4%. Metals as an index is staging a rebound in today's session, and Vedanta, Hindustan Copper, almost every index constituent trading with gains in today's session. Some stocks that are doing well on the back of volumes, and Safari Industries is one ahead of results today as well, off the highs of the day, but still 4.5% higher. Ramkrishna Forgings and Triveni Turbine also seeing some gains on very strong volumes today. And lastly, some of the losers within the broader markets, not many, but EIH also down 6.5% on strong volumes. LIC Housing Finance and Bata is a result reaction, not having a good day at the office today. Back to you guys.
Okay, all right. So those are some of the stocks in the broader markets that are in focus. Thank you so much, Hormaz, for joining us as always. It's a good time to welcome Ruchit Jain from 5paisa.com for a technical check on the markets. Ruchit, good afternoon. Thank you so much for joining in. We did see a gap up opening yesterday as well, but we could not maintain those levels. Is this something which could happen today? What are the charts suggesting now?
Very good afternoon, Sonal. Very good afternoon, Vivek. Well, we had seen a gap down opening at the start of this week, and since then, last 3 trading sessions, the market has not been able to surpass that hurdle of 24,350. And the correction which we have started at the start of this week has not yet completed its 38.2% retracement. Historically, we have seen that in this entire uptrend, whenever we see a price-wise corrective phase, markets tend to retrace about 38.2% of the previous up move which is now placed around 23,630. So I think we are not out of the woods yet until we see market sustaining about that 24,350 to 400 range. I think at higher levels, we would continue to see some selling pressure. So only about 24,400, one should look for any kind of no significant pullback. Otherwise, I think still no markets could see some more dip again towards 23,600 in the near term.
Welcome, Richard, to the show. Vivek this side. Richard, which are the individual stocks that you like at current levels?
Yeah, hi Vivek. So a couple of recommendations. One would be on buy side and one on sell side. Selling is clearly seen in banking and the NBFC space where the relative underperformance is there. So IndusInd Bank within that basket has breached its previous swing low. So continuing its lower top, lower bottom formation, which is not a good sign. So this is a sign that it may continue its down move. So one can go short over there, keeping stop loss about 1,375 for potential targets around 1,280. And I think selective pharma names have been outperforming. And in fact, when times turn volatile, I think pharma, FMCG, these are the names where we usually see outperformance. So Alkem Labs within this entire pharma basket is looking quite positive. A decent amount of consolidation has been seen in last 1.5 months. Now a breakout above that consolidation is due, which we can see today. So Alkem Labs can be bought with stop loss below 53.20 for potential targets around 5,650.
Okay, all right, Ruchit, thank you so much for joining in. Those are some technical bets for the markets. Let's step into a break. Up next, Janu Mohanty Lakshman Rao from Moltech Packaging will join us to discuss their Q1 numbers and the outlook going forward. Stay tuned. Welcome back. Let's talk about Moltech Packaging. Reported a set which was lower than street numbers. Sales volumes grew by 7.5%. Revenues grew by 5.8%, while profit after tax slipped by 12%. To discuss this and more, we have Janu Mohanty Lakshman Rao, the Chairman and Managing Director at the company, joining us now. Mr. Rao, good afternoon. Your sales volumes grew by 7.5%, while revenues grew by 5.8%. Was there some pricing pressure that you saw this quarter? What is the outlook in terms of volumes for FY25?
See, the volumes have grown better than last year. Last year, growth was tepid. It was only 4.8% for the full year. This year, we clocked 7.5% in Q1. And as our projects for Aditya Birla Group and Pharma, total 3 units, have gone into commercial production, all those costs associated cannot be capitalized anymore, and they have been taken to the P&L. So that has impacted slightly the margins. However, the EBITDA grew by about 3% overall in absolute numbers. Per kg, it's come down marginally from 37.7 for the full year last year to 37.06. This is because of higher costs have been now absorbed in the P&L due to the commercial production of all these 3 plants. So going forward, ABG plants are expected to pick up volumes. And similarly, Pharma, we have 7 companies already audited our facilities, and half of them have cleared the facility for commercial production. And we have also been very lucky to get 7 to 8 new product developments for pharma companies, which will certainly lead us into the pharma packaging in a big way in the next couple of quarters. As you know, pharma require a lot of statutory compliances and stability tests. The process of selection is slower, but I am glad that already 7 companies have selected us and 7 products are under development. That should lead to growth in the coming quarters.
So there is basically no pressure on pricing, so to say, is what you're saying. I just want to understand that differential between revenue growth and volume growth.
See, our product mix makes the difference. The growth, paint and pails will not lead to higher EBITDA improvement. So if the food and FMCG growth was sustained more than 15-20%, that would have improved the margins. But because of pails and square packs are the leaders in growth this year, this quarter, our margins are under little pressure. But going forward with pharma, which has almost double the margins, will be start contributing maybe from Q3 or Q4 onwards, which will again take back our status in EBITDA margins.
Understood that, Mr. Rao. Mr. Rao, so it appears as though on a weighted average basis, the NSR, the sales pricing seems to have dipped around 2% on a year-on-year basis. earlier you had given us a volume growth guidance of close to 15%. Do you stick to that guidance? You also mentioned you've started supplies to the Grasim plant. So going for, did you in this particular quarter see the full impact of that particular supply coming in? And Q2 onwards, what is it that you've penciled in from the Grasim facility?
Yeah, Grasim facilities are picking up pace now. They started picking up from March, but the numbers have really started building up from June, July onwards. And going forward, the indications also are reasonably strong. With that in mind, we are still sticking to a good double-digit growth. It could be very close to 12 to 15% range at least, if things go as our plans.
Okay, and the current Cheyyar, Panipat and Sultanpur plants, they are currently operating at 15 to 25% capacity utilization. What is the target by the end of this year? What levels can you reach at in these facilities?
Already in ABG plants, we are now crossing 50% in this quarter, July and August onwards, and probably it will pick up. And we are in fact adding facilities at both Cheyyar and Panipat to be ready by December, January. So capacity utilization of current plant will certainly reach a good number in the at least 70 plus by the third or fourth quarter in those two Cheyyar and Panipat plants. In pharma, we are currently hardly using the facility, about 75-80 lakhs worth of invoicing we did in this quarter. But that number will start doubling. Hopefully by fourth quarter, it will be a sizable contributor, something around 5 to 8 crores in that quarter. So that is the target we have, but I have more clarity by October this year.
Okay, Mr. Rao. Mr. Rao, coming back to the volume, you've given a guidance overall for 15%. Now, in the paint segment, what is it that you're penciling in? Is it double digit that you're penciling in? And pharma, while you said you've onboarded quite a few new clients, do they start, coming into your numbers from FY25 itself? And what will be the volume growth that you expect over there?
See, coming to the paint industry, I am hopeful of closely coming to a double-digit growth, which was negative or nominal till last year, thanks to ABG's new edition of business. And coming to pharma, by Q4, we expect the numbers to be at least contributing 2 to 3% to the top line, with a stronger bottom line because of better margins there. And next financial year, these 7 products, what we are developing now, themselves have a potential to reach 40 to 50 crores turnover. And in addition, there could be some more products that may come up, or even the regular products we may get orders during the next few months of the current financial year. So I am very bullish on pharma packaging. Going forward, that will be our growth leader.
Okay. Mr. Rao, I wanted to understand the impact on profits this time around. High depreciation, high interest is something that impacted the bottom line. What is the quarterly run rate that you're looking at in terms of interest costs and depreciation now? Most of your capex is done as well. Is this something that will continue to impact profits going forward while you're very bullish on the top line? What is the growth target for the bottom line?
See, as you correctly said, higher depreciation and higher interest has depressed the net profits for the year by almost, for the quarter by about 8%. But going forward, these facilities, almost 250 crores have been invested. There's half of our assets are invested in the last 2 years, and they are yet to fully come into commercial use. So going forward, as the productivity and capacity utilization improves, the bottom line also will improve. So I am confident that the growth will be visible towards the last 2 quarters of this year, and definitely from the next financial year.
So the interest cost capitalization or the interest cost accounting, most of it has been done now?
Yes, most of the capitalization is no more available. It's all going to the P&L. That is one of the reasons for the depressed PAT.
Okay,
And even from 9.4 crores last Q1 to 11.55 crores.
Okay. Thank you so much, Mr. Rao. Thank you so much for joining us and explaining the numbers and the way forward. We'll now slip into a short break. When we come back, we'll put the focus on Cummins, which has seen a very sharp intraday recovery. Stay tuned. Welcome back to Mid Cap Radar. The market continues to stay quite steady. Cummins is the stock in focus. It's surging in trade today on the back of positive management commentary during the earnings conference call. The company indicated that it aims to see 13 to 14% growth in FY25. Varmakshi is here with more details.
Well, absolutely. Cummins is surging in trade after a positive commentary that came through from the management. It was a mixed set of numbers, but the commentary is pushing the stock higher today. On growth, domestic as well as the export markets, the management said that they are aspiring to grow nearly 2 times of the GDP growth. They're targeting 13 to 14% growth in FY25. They also went on to clarify that the global parent commentary that came just a few days ago, after which we saw a very sharp fall in the company, does not apply to Cummins India only. That means it applies to all of their India entities and not just Cummins India. Domestic demand in various end markets is expected to sustain. Exports, according to them, have now bottomed out, and exports are seeing an uptick on a sequential basis in Q1, and that is mainly on account of recovery in Middle East and green shoots in Africa. But how much of this export demand will sustain is difficult to call due to geopolitical risk, is what the management has highlighted. As far as margins are concerned, they stand at a record high, but they're expecting some pressure to come in going forward. They think that such record high margins are not sustainable. On transitioning to the new norms, that is the CBCP4 gensets, they say that the new products accounted for nearly 30 to 40% of their sales. On an average, they are priced nearly 15 to 25% higher. But despite that, the demand is quite steady. They're not, however, ruling out some readjustment in pricing for certain nodes for this new product. On growth opportunities in various segments, they appear to be quite optimistic. They continue to invest in electrification cycle of railways. They have products that are certified and approved and are currently being tested here. They're optimistic on the future of railways, and they see a very huge opportunity for Cummins India here. Data centers contributed nearly 10% to the company's revenue in the power gen business, and the capacities for heavy data center applications are now completely booked as per the management. Overall, they have highlighted that they are at an inflection point, and this kind of growth can sustain for many, many years going forward. So overall, positive commentary pushing the stock higher in trade today.
Oh yes, very positive commentary there. 6.5% higher on the stock, which actually started in the red and saw some recovery. By the way, just wanted to point out BASF, that stock is surging in now. Just reported numbers a while back. The stock is up 17% now, and remember, it's coming for an agrochemical company, the sector which has not been doing well, and it's the second consecutive quarter of growth that we have seen for this one. So that's why margin expansion, profit expansion, something that the street seems to like, and that's why that 16% uptick that we are seeing on the stock today. The other stock on our radar, Symphony. It reported a good performance in Q1 and also announced a buyback of 71 crore rupees. The stock was up 20% yesterday. Today as well, it's higher by 4%. Earlier today, we spoke to Rupesh Shah, who is the managing director of Symphony, to discuss the company's performance and the new launches. Listen into what he had to say.
Whatever initiatives and measures we have taken in last 3-4 years in terms of expanding the product range. On top of it, just yesterday we announced launching 17 new path-breaking models in air cooler. In addition to that, also entering into water heater. Of course, in year 1 and 2, it won't be really meaningful. And on top of it, now we have a decent presence in semi-urban as well as rural market on account of continuous expansion. And even our D2C has registered the EBITDA margin percentage in line with the normal business, which was negative until last time. Quarter has been the best. We hope it will be and should be the best year ahead. About 30% margin, we are ensuring our and trying our level best to reach to that level. But our June quarter EBITDA margin has been the best ever.
Well, that was the management of Symphony. One more stock on our radar is Venky's. The stock has hit an upper circuit after reporting a very strong set of numbers. If you could quickly look at the numbers, the revenues, though they were down almost 17% on a year-on-year basis, EBITDA has come in very strong at 100 crore, a little over 100 crore versus just 31 crore last time around. The company says that they actually saw improved realizations coming from the sale of chicks as well as grown-up birds. On the back of that, if you look at the margins coming in at 12.8% versus 3.2%. What did all of this translate to? Profitability coming in at close to 75 crore versus just around 19 crore last time around. But that's all the time we have on this edition of Mid Cap Radar. Your stocks when we return.